Let's get in some perspective on the debt markets now. You had Saurabh Mukherjee earlier talking about the bubble that could be created into debt markets. Aditi Nayar, principal economist at ICRA, is now joining us on the phone line. Aditi, you are also of the view that foreign inflows into Indian debt are unlikely to sustain, especially in the next year?
Thanks, Pankaj. Certainly what we've seen in the last couple of years is a lot of volatility. We had a great year for Indian debt in FY15 when we had massive inflows coming in from the FII side. And then we had 2 years where we had inflows in some months and outflows in other months, leading to average outflows if you look at the year as a whole. Last 6 months, again, there's been a huge amount of volatility. From October to January, we had more than $7 billion of flows. And that's been followed by a larger amount coming in the last 2.5, 3 months alone. Our view is that certainly an average of $2.5 billion a month from FIIs into the Indian market is a pace that is highly unlikely to sustain over the rest of the year. Overall, we think that FII inflows into the debt market alone would be limited to around $5 to $10 billion for FY18 as compared to the $2.5 billion or so which we've already seen coming in the month of April.
Right. In terms of flows, are you expecting a big redemption or any pressure with the sort of inflows that have come in?
Look, there's going to be three major factors which are really going to drive the FII's decisions. One, of course, is going to be the competition of yields, which we're expecting between U.S. government.
Right, I think we lost the voice over there. Aditi, I think there was a network issue over there. Can you just repeat your answer? What do you think will impact redemption, if ever?
So, Pankaj, we think that mainly there are going to be three issues that are going to be driving the decisions related to Indian debt in the rest of this year. One is going to be a compression of yields, which we're expecting, particularly between the U.S. And the Indian government securities, led by 3 or 4 major factors. The Fed, we think, will tighten at least 2 more times this year, and once they start to taper the reinvestment of maturing bond purchases that they had made in the past, both of these factors would lead to a rise in yields as far as the U.S. debt is concerned. In India, we're seeing a prolonged pause from the RBI, particularly because 2 of the major factors that would affect the inflation trajectory are going to be unclear for at least a few more months. This is the impact of the GST as well as the impact of the monsoon. So that the rather hawkish minutes that we got from the MPC last week do suggest that we're going to have a fairly prolonged pause, and therefore, while the Indian yields would remain firm, they may not go up further, and therefore the spread would compress over this year as the yields start to go up in the U.S. Secondly, of course, when there are geopolitical tensions, we do expect that there would be sporadic outflows as well, similar to what we saw between October and January 2017. And thirdly, if we look at, overall what has happened with the rupee as well, it's appreciated very, very strongly over the last couple of months, and that pace again may not sustain going forward. So if there is a depreciation of the rupee going forward, then that would have an impact on the currency-adjusted earnings of the FIIs as well.
Right, but say if the rupee stays where it is, in and around a 2-3% band, how it was stable earlier, do you think that will prop up more flows?
I think that probably we've seen a very large chunk of the flows already, and therefore what we see going forward would be quite limited from 1 month to the next. We don't expect that this kind of a pace would sustain. So overall, our baseline view is that this year we are only going to see $5 to $10 billion of money coming into the debt market. Of course, this may be overshot. I mean, there may be months where there are large inflows followed by outflows, particularly triggered by geopolitical events. So on average, we don't think that the total is going to be more than $5 to $10 billion. Having said that, that's much better than what we've seen in the last 2 years, which were small but net outflows.
Right. Also, could you just tell us about the recent Monetary Policy Committee minutes? What you read into is that there will be a prolonged pause before there is a hike or any change?
Right. So if we look at the trajectory itself that the RBI and the MPC had indicated, which I think only one of the MPC members has differed on in a material way, is that they expect CPI inflation to average about 4.5% in the first half of this fiscal, and then to rise to about 5% in the second half of this fiscal. So already the trajectory itself that they're looking at builds in inflation going up, and therefore moving further away from that 4% midpoint of the inflation target that they really want to get to in a durable manner. Now, of course, in India, given the kind of volatility that we have for food inflation, there is always going to be some minor shock or some base effect related to an earlier shock, which is going to complicate the trajectory. But overall, we don't see the RBI being convinced that inflation is going to come durably to that 4% mark in FY 2018. So that is one concern. Secondly, as I mentioned, if we look at some of the major risks that the RBI has and the MPC has outlined, two of them are certainly not going to be very clear over the immediate term. So one, of course, the monsoon. There are now indications that the El Nino is not going to be as feared in the second half, but we're only going to know about that closer to maybe August or so. So for the next 4 months, there is going to continue to be lack of clarity. And in any case, IMD has given for the monsoons, it's going from 91% upwards. So it's not as if the lower end of the range is giving us too much comfort. And secondly, also, if we look at the GST, if it does come in on July 1, we need at least a couple of months for the inflation impact, if any, to play out and to settle down. So one concern obviously is on the services side. If services
Right. All right. Aditi was talking about the factors that she's keeping in mind. Looking at the MPC commentary, she believes that the RBI could be on a hold when it comes to interest rate cuts for some time. Aditi, you were not expecting further inflows into the bond markets. Where do you see the rupee then headed? Do you think this is as strong as it gets? Could it then weaken from here?
Well, Anisha, currencies always tend to overshoot in one direction or the other. So I'm not saying that this is the end of the appreciation that the INR has seen. We might see it strengthen further, particularly if inflows come in the near term. But if we look at a slightly longer term view on the rupee, I think there would be 3 or 4 major factors that would have an impact. One, how is the rupee appreciation going to start affecting Indian exports? Both on the merchandise side as well as on the services side, in terms of the export competitiveness, there will certainly be a hit in some sectors, and that should start showing up in weaker export growth numbers a couple of months down the line. Secondly, in any case, given the kind of commentary that we're seeing, particularly from the US, are services exports really going to be able to sustain the kind of momentum that we've seen in the past few years? Will remittances be able to show any kind of momentum with crude oil prices having settled back down, and with the impact that they may be on H-1B visas, etc.? So there are certainly a number of concerns that the rupee could have on the current account deficit as well. Right now, our baseline expectation is that the current account deficit would be around 1.1% of GDP in FY18, which is a very comfortable number. But these factors that I mentioned would push up that number, if anything. Also, stronger rupee would encourage more gold imports. So overall, it would not paint a very comforting scenario in terms of the current account deficit, which we think may slip beyond our baseline expectation of 1.1% of GDP if the rupee continues to strengthen or even remains at these levels. So that would be one factor that would sort of, be an automatic stabilizer, perhaps getting the rupee back in line. Of course, inflation differentials would remain fairly large, particularly if the trajectory we were talking about for Indian inflation would continue over the rest of the year. So that would be another fundamental factor that would support a depreciation from the current levels. And if FII flows start to taper off, or if the RBI chooses to add to its forex reserves, then even those factors could lead to some weakening of the rupee.
What kind of RBI moves are you expecting when it comes to currency stabilization? They said that they'll move in if there's volatility. But at these levels, do you think the RBI will be comfortable? They already have a large reserve. Will they come in to then try to see that the rupee weakens?
Maybe not immediately, and certainly they may not choose to intervene aggressively unless we start to see very sharp moves on a daily basis. So we've seen in the past when the rupee weaken or strengthen more than even 70-80 paisa on a daily basis. So I don't think that the RBI is going to intervene very aggressively unless we start to see very sharp movements like that. Of late, what we've seen, other than a couple of days which were triggered by specific events, the appreciation of the rupee has been a bit steadier and not been quite as sharp or spiked as much as what we would have seen in the past.